Welcome everyone, and thank you for joining iShade today for this webinar and Ask the Expert session, Building Your Practice During Tax Season Part 2, presented by Peter Vessenes. With over 30 years experience in the financial industry, Peter is the CEO and founder of Prophecy Incorporated, a financial software service for financial professionals, CPAs, and pro advisors. Prophecy is an all-in-one financial analysis and budgeting software from seasoned financial experts. Prophecy helps business owners and financial advisors alike gain powerful insights to manage cash flow, grow profitability, and increase valuation. Immediately following today's webinar, join us online from 3 o'clock to 3:30 p.m. for our live online Ask the Expert Q&A session on iShade.com. Peter, thank you for joining us today. You can go ahead and take it from here.
Excellent, thanks. First of all, welcome to everybody. Really appreciate you taking a break out of this insane season now coming up over the next few weeks. And especially for those of you who are here from having listened to last month's presentation on this, I hope this is going to be valuable to you. You're in an incredible time of the year, and believe me, I understand your pain. This really is the busiest time of the year for everyone because of the deadlines, and I know we do extensions and so on both on the business side and personal side in September and October, but this is that kind of blitz season. You know, you're putting in 14, 16, 18 hours frequently, and yet there's certain things that occur at this time of year that really can't happen at other times of the year. And the first is tax season is singularly the most important touch of the year. Now, what is a touch? A touch is when I have actual contact with my client and in something that's of critical importance to them, which is their money, right? Because what is the objective of what we try to do from a tax standpoint? And that is to make sure that they're only paying taxes that they are required to pay. And of course, the tax law is extremely complicated. It's why you guys do and ladies do so many CPE credits in a year. But it is really the most important touch of the year because this is really how your clients draw their impressions of who you are. Now, understandably, because you're getting assaulted from all of your clients at once, it's not like you have a whole lot of time to sit down and chat and visit with them and so on. Yet, for many of you, this really is one of the only times that you might meet with most of your clients. Now, you know, I know my CPAs take me out golfing in the summer and get together every so often, but, you know, this really is where your clients form their impressions of you. And it's really, really imperative that you're thinking about that and how you're going about doing it. Now, for those of you that have been following some of the things I'm training on, you know that I'm really into fiscal management, because it's how people manage their capital and resources that goes beyond tax and audit. If it's on a personal side, how much does it really cost to retire? How do you account for basically long-term inflation rates? Just because someone's making a lot of money doesn't mean that they're going to be in a good position to ever retire. Some people spend as much as they make. Other people feel like they've labored so long, now's the time to reward themselves. Other people are kind of tight with a nickel, and they basically stress and work too hard. Fiscal management is not strictly tax and audit, and it's more important in a business, especially for your business owners, than it is on an individual, because generally a business owner's single largest asset is their company. So the question then becomes, why do your business clients really deserve a business financial review? The whole objective of last month and this month's presentation from me is to be able to utilize this time where you're in touch with your client and introduce to them the idea that you're going to do a business financial review. Now, last time I talked about how you apologize for not doing it. You've trusted me all these years to work with your tax and audit. I really owe you an apology. You know, I do the taxes for your business, but I have to apologize because I've been delinquent in being able to do a financial review of your business. not just a tax review. So it's really important that you understand that your business deserves a financial review. And why is that? Well, if you are going through the business financials, and if you even print out certain simple things like key performance indicators, balance sheet, cash flow statements, P&Ls, you basically have taken on a fiduciary responsibility with the business. Now, again, most businesses don't think about suing their accountants. But if you have a business that you're working with and they have some issues, and you don't talk to them about it, warn them about it, you could be sued. This is actually, we're a very litigious society. This is actually starting to happen in some places where businesses are, suing the accounting firms. And I know when you do an audit, there's always this disclaimer in the audit, blah, 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 blah. But that's not the same thing as understanding that a business has a fiscal challenge ahead of it. So the key thing to understanding how to provide a financial report to your clients is to really come to terms with what your clients do not understand, right? What is it really they don't understand? Well, they don't really understand the meaning of generally accepting accounting principle vocabulary. We can get very basic. A profit and loss statement does not tell them whether they're profitable or losing money. Is it done on accrual or is it done on cash? Even that doesn't tell them what the real cash expenditures are, because certain parts of cash expenditures only appear in the balance sheet, and even then it's not obvious. Principal payments on loans and notes appear as reductions in liability. So they wouldn't even know where to hunt for it. Now again, we're trained in the industry. We know what the vocabulary means. It seems simple to us, but they don't get it. They don't really understand what the vocabulary of accounting is saying, even what the words mean. Most people do not understand what the definition of a key performance indicator is. I know in Prophecy software we support like 24, 25 KPIs, and frankly, what we had to do in this was create a little question mark that you can highlight over, and it actually defines what the KPIs are measuring. Now, just because you even know what they're measuring, do they really understand what the ratios mean? Why something might be good or why they won't? Again, we work in this. It's plain to us. They don't get it. Think of your business owners. What is it that they're good at? Well, they're good at their services, or they're good at sales, or maybe they're a distribution company, or maybe they're a dry cleaning organization. Any number of types of businesses that represent that small to mid-sized market. Maybe they're a discrete manufacturer, a tool and die shop. Maybe they're a farmer. They really don't know what the KPIs mean. Yet the KPIs are very important. That's why they're called key performance indicators. So they don't get it. Why a bad KPI really is bad? What is it implying? Right? Again, I'm not here to explain what these mean. I'm assuming we know what those mean. But they don't understand when a KPI is out of kilter, why it's bad, what it implies for the business. They certainly really don't understand how to impact changes to the KPI. Now, I'm not saying that everybody who's in accountancy really understands proactive fiscal management of a company, or operational management of a company, or strategic planning in a company. But it's very, very important to understand what types of activities that businesses can take for making shifts in what the KPIs are defining. So it's really imperative to know what they don't understand. They don't understand what a balance sheet forecast is or why it's important. That's what they think their profit and loss statement is telling them, but it really isn't. And again, I did a presentation on balance sheet forecasting last year, and I think we had like 135 attendees. It was a huge number of people, but it is important. Banks and lending institutions are requiring them. It is really the way of forecasting what actual cash positions are going to be in place when you account for things that only appear in the balance sheet as opposed to P&L, and when you account for projections on aging, receivables, payables, 30, 60, 90 over 120, even how do you account for budgetary projections, growth, tactical strategies. Balance sheet forecasting is very, very important because that is painting the picture of the financial future of the company. So I really believe the objective of financial advisory services, not tax and audit, but actual fiscal management of a company, revolves around how do we improve their financial stability, how do we help them understand their capital needs for growth, how do we increase profitability, how do we raise valuation, how do we help them discover how to create a succession plan, because singularly, if their largest asset is the business, and they don't plan on at least working 70 hours a week till they die in their boots, they need to know how to capture the assets of the company, and they really don't. Balance sheet forecasting is probably one of the most important tools for doing that. How do you grow the business within acceptable levels of risk? You know, we know how they think. Well, is there money in the checkbook? Oh, can I afford to do it? That's money out of my wallet. All these things that happen. Again, this is why people in multinationals have analysts who create these impressive spreadsheets, and frankly, that's why I built, Prophecy to make it available to the SME market through you guys. How do you grow the business with acceptable levels of risk? When do you spend and when do you save? And I still remember years ago sitting down with some of my business clients who were telling me that their accountant told them that they needed to buy an expensive piece of artwork now before December because of the tax advantages. I looked at them, I said, you don't even like artwork. I know, but that's what they told me. That's not a when to spend and how to spend and when to save. But this is a, oh, okay, we have this option for creating a depreciable asset in a tax advantaged position. I would have rather the accountant had told them, this is what we need to do. What types of things would you be interested in investing in to take advantage of the tax situation, rather than making a recommendation for what to spend and when to spend. At any rate, they really don't know when to spend and when to save. Most of them don't understand what capital reserves are. In other words, one of the simple models that I would use is if receivables, not just aging, but all receivables went to zero, and I made an adjustment on my variables and I had to cover all my expenses, how many days of actual cash can I float the business on capital reserves? And I had some numbers that I believed in that created financial stability. Then, of course, at the end of the year, we would do adjustments based on taxable issues. But the point is, very few of them have any idea what they need in terms of capital reserves. Money for growth. You spend money to make money. I spend money today, I will make the money in 60 days, 90 days, 120 days. Depending on the industry, depending on the service of the business, they're all different types of models for doing it. Just in time. An incredible part of reducing inventory. When do you discount product in order to clear the shelves so that you have the velocity of money working for you? I'd rather make 1% on my inventory every day, 30 days a month, than trying to make 12% on my inventory each month. The velocity of money tells me I make more by turning quickly. So, at any rate, what is the money that's needed for growth? Money for risk. Nothing ever remains the same. Market conditions change. Life conditions change within a company. What if they lose a key employee? What if they suddenly discover that a distribution channel that they were working with suddenly goes out of business and they don't have an alternative distribution channel? What if, God forbid, the government comes in and completely regulates the internet to the point where they kill it because they want to tax it, which hopefully is not going to occur, but the administration seems to want that to happen. Where do you have capital to help manage risk? Not just risk that's known, but risk that might be unknown. Do they really know how to do that? I don't think they do. For these reasons and many more, you really need to conduct a financial review. Okay, so why do you need to conduct a financial review? First of all, they don't have anyone else to ask to have them do it. Who do they trust? We've talked about this many times. They don't trust the employees. They can't talk to their significant other. They're certainly not calling the lawyers. They don't like talking to other business owners. At least the men don't because of the posturing. They really don't have anyone else to do it for them. You're the people that they trust to know about their money. You have a fiduciary responsibility. I really don't believe that our responsibilities end with tax and audit. I really believe if you acknowledge that they don't know a whole lot about fiscal management. Now, even those that are doing well, even those that are very, very profitable, good for them. But frankly, even if they are doing very well, you need to be able to give them assurances that they're doing well and help them understand what the KPIs mean. There is a fiduciary responsibility attached to this. Now, if you do a review, what happens if everything is okay? That's great. You say you're in a solid position. Your cash reserves are in good place. Your debt to equity ratios are solid. Your valuation is probably a little better than you think. You have an opportunity to continue to build this business. I think it's great if everything is okay. I just think the number of companies that you help where everything really is okay is much smaller than you might think. This is not the mid-2000s. I call that the period of irrational exuberance. This is still, we're still suffering from the entire financial dynamics of what happened in 08 and 09 and 2010. Mean wages in the U.S. are down about 10%. Employment, all new jobs that have been created don't match the number of illegal immigrants that are coming in and taking jobs in the U.S. Things are not great. Now, if your company, your client is doing okay, that's great. It's wonderful for you to tell them. But there almost always are issues. And frankly, they don't have a chief financial officer. Their expertise is not in fiscal management of the company. So a lot of people have asked me, well, when you do a review, what do you really put into the review? Well, I mean, the first thing is we try to do an assessment of what they're doing well. It's just imperative that you cheerlead your clients. I think most people are afraid that there's something that they're unaware of, that they don't know that's going on, and what happens if that happens at them and they didn't know. I mean, there's no greater sense of regret or fear that you're doing something wrong, you didn't know about it. It's really being blindsided. What they really need is the affirmation that they are doing well. Even if it's simple statements like, look, for how the market has changed and for the sector you're in, you're doing well. These are the items you're doing well. Whenever you do a financial review, you always have to start out with the cheerleading. It's, again, we're building trust relationships. And anytime you do a review, you really have to affirm to them what is going correctly, what is going on in an effective way. You need to highlight the report on what is not so good. Now, usually, what we've done is we just do the general reports of the profit and loss statement, the balance sheet. We do cash flow forecasting. We try to look at some of the statements, balance sheet forecasting. We take all these statements, we take the KPIs, and we print it all out. It's a nice big lumpy, it's about 25 pages of information, and it's a lot of numbers and a lot of graphs and charts, and of course they're getting dizzy. But I literally highlight on the report what's not so good. Yep, now I know it's a lot to read. Go to page 3. I notice I've highlighted in yellow. Here's on page 3. That worries me. Here's why. Go to page 7. Okay, all of page 8. And I'm literally going through on the report what is not good. I want to highlight what is not good. I want them to see potential longer-term consequences on issues they control. It could be anything. It could be on capital management. It could be on compensation. It could be on issues of capacity. Maybe they're so overworking their staff with overtime, it'd be cheaper to hire some additional people. Maybe it's apparent that they have a bottleneck in something that's going on. I want to make sure that they understand the consequences of what might happen on elements they control in the company. I want to make sure that they understand potential longer-term consequences on issues they do not control. That might be changes in regulatory law. It might be changes in the marketplace. It might be emerging things in technology. It could be any number of things. But I want to point out that there are consequences on things they don't control, because part of fiscal management is how do we manage against things we don't control. In our company, we spend a lot of time talking about what do we spend most of our time doing? We spend most of our time managing against the limitations and liabilities of our trading partners. And this includes everything from software accounting firms to relationships we have within communities. There's all kinds of things that you try to manage against. And you don't have control of those circumstances. You just have to learn how to manage against them. So you want to point out to them longer-term consequences on issues they don't control. Most important, they need to have a sense of deep calm emanating from you. You have to have such a presence that they feel safe in what you're telling them. I might be telling them this isn't and that's bad and you're going to have this, but it's just imperative that my aura, the way I'm communicating with them, brings them a deep sense of calm that if they basically stick with me and we continue to communicate and we continue to talk, things will be well. If there's anything that's imperative in these type of relationships, it's them believing that you are really interested in them, that you have a concern for them, and that you're calm about what we can do. Even if it's a company that may be facing bankruptcy, you still have to be that calming voice that says, this is how we'll do it. These are the things that we face in reorg. These are maybe tactics. There are tactics we might be able to take to help offset this. But even those that are in the most challenging circumstances and positions, it's very important that you become the calming factor in their lives. So let's talk about what's not in the review, okay? I never explained what might have been the underlying causes of any issue. I'm not explaining to them what brought this about. Frankly, that's my professional advice, and I get paid for that. I'm not going to explain to them what are the underlying causes. I'm just there to point out the situations and the circumstances. Never explain the underlying causes. When you say, if you're asked, well, what causes that? What causes that? You say, you know, there's a lot of elements in this, but this is why so many of our clients put us on retainer for helping them with fiscal management. We become like a virtual CFO to the company with our business clients. So I don't explain what the underlying causes are. And when I'm asked directly, I say, you know, that's a great question. I really understand. That's why we do this. That's why we create those advisory. I'm never, ever going to give any implication of blame. Never, never blame your client. Even if they did the most obviously stupid thing on the planet, there's never an implication of blame. Nobody makes mistakes on purpose. They don't do it because they're seeking revenge or they're masochistic. They don't get it. So you never, ever want to give any implication of blame. Mostly, I never talk about how to solve the issues. Never do it. We're not here at this point to solve the issues. We're here at this point to point out the issues. That's what a review is about. A financial review is to point out things that there are pain, challenges, problems, mismanagement of assets and resources within the company, because that's what's reflected in the financial reports. Now, for many of you, remember I talked about escalating their stress. Now, there was a nice blog that was written about my comments on this, and let me start out by saying I never, ever really want to, and I never will, artificially escalate anybody's stress. I'm not interested in trying to artificially create anything in them. I do think it's important that if they have challenges with the company, that their stress goes up, right? So this is why the first question is, are things really okay? Are they really okay? Well, there's a difference between you raising their stress and knowledge raising their stress. My objective in a review is that the knowledge of what's going on and the understanding of what's happening financially does escalate their stress. I want their stress to go up. And why? People don't make changes unless they're in pain. Very, very few people will change old patterns, old habits of behavior, old ways of doing things, unless they become certain that continuing on the same path is just going to make it more challenging, more difficult, more painful. Everybody is resistant to change, especially change that revolves around changes that they don't really know how to do, that they don't really have a background on, that they're not really sure what's involved in doing it. Okay? So there's a huge difference between you raising their stress, which I don't ever want to raise their stress, but the knowledge that I'm bringing forth raises their stress. This is why I so emphasize you have to be the voice of calm. You are the one that has the center of peace that is so profound to them that they really, in the middle of the stress, they believe you're their way out of the storm. All right? So there's a huge difference between you raising their stress and knowledge raising their stress. So I really believe that stress about financials is good. It's good because that's what prompts people to learn and make change. So once you've done that, what if everything is okay? Affirming to them that everything is okay is imperative. They want to know, I've done a good job. This is really great. Now, that doesn't mean that I don't have an opportunity to continue to help them. It just means that they've done a good job of the capital management of the company. So what if everything is okay? Does that mean, oh, that's okay, you're financially fine, there's no opportunity for me for service? No. Can you honestly tell me they know how to build their budgeting to account for seasonality and variance? Do they really know how to build a budget to account for growth strategies? Do they know how to build what-if scenarios that help them understand from a cash flow basis how much it's going to cost over the next 6 months in order to create this new opportunity? When does it cash flow? What's its real rate of return over a longer period of time? What time of the year do I start doing it from a tax advantage situation? I will guarantee you they don't know how to do that. They're doing this out of a gut sense. Frankly, if their fiscal management of the company up to this point is okay, to me that's a lot easier to work on, because otherwise in the times where I'm holding my monthly meeting with them, my chat, I'd have to spend half the time calming them down. When someone's doing better, the idea that I can help provide advice to help them do phenomenally better, to help them reach longer-term destinations, to raise valuation, to create a succession plan, to slow down the pace that they have to live at, I think that's a huge value. So if everything is okay, they might not be stressed, but I need to raise their awareness of things that could be operating better. And that's an imperative part. Not everybody you talk to is going to necessarily be in deep weeds financially. But even the ones that are doing better doesn't mean they really understand all the elements of building a higher value business. And this is where we can be absolutely, undeniably valuable. So what if everything isn't okay? Well, if everything isn't okay, then this is where they need help. And you have to ask themselves, where are they going to get it? Is it bringing in a new marketing director? Is it bringing in a new sales manager? Is it deciding that they need somebody more than just does bookkeeping? Maybe they've hired someone that they believe is controlling finances, but really they're just a controller. They're just a cost person. And you know, you can't always just reduce costs and things that makes the company better. Sometimes there's issues in capacity and resources. And sometimes adding people so improves efficiency that the profitability goes up over a matter of 3 or 4 months. There are lots of reasons why things are not okay. For those of you that have sat in some of my other presentations, we've talked about what are the 8 disciplines, right? Client experience, sales process, strategic marketing, I call it the top-of-mind awareness, efficiency, mid-office, back-office workflows, compliance and regulatory, technology, human resources, and Org-D, fiscal and asset management, strategic and functional business planning. Where do you find somebody that you just, quote, add to the employment? Can they really afford someone that's going to cost them $8,000 a month, $10,000 a month, $15,000 a month? Usually they don't. But they can't afford you on a retainer. And that to me is what the key to this is. What if everything is not okay? If it's not okay, I want to position myself as their CFO. Okay. So I'm asked a lot, how do you build a proposal? What goes into creating a proposal? Well, you know, there are a lot of steps in this. But first, always, is I have to define what are the services. What is it that we're going to really be offering? Well, I really believe that I want to talk to them every month. A monthly financial review. Now, if they're a smaller business, a micro business, under $1 million, it might be quarterly, all right? But I want to make sure that there is a financial review that takes place. And what is the objective of the financial review? Well, it's basically to be able to take the P&L and the balance sheet reports and the vocabulary of GAAP and help them understand what do the KPIs mean, why the balance sheet doesn't tell you profitability, why we need a true cash flow projection, what is a balance sheet forecast. I want to systematically educate them on understanding fiscal management. Now, I've been asked if you do this, you know, A, how long does it take, and B, don't they eventually learn what you know? And I will say, yes, it takes a long time. It can take a year. It can take more than a year, 2 years, to help them gain the wisdom of fiscal management. And you say, well, I don't even know all of that. That's okay. You only have to stay 1 month ahead of them. Go to our website. Go to others that talk about this. There's lots of resources you have available through the World Wide Web for you getting better at doing it. But it's imperative that they get educated. And at the point at which where they even know all of this, they're still not going to dismiss your services. You're going to be the trusted advisor. You're going to be the one that they make the decisions with involving the advanced stuff, like tactical strategies, scenario building, future growth, succession planning, how to manage capital resources when things are going better. So I want to make sure they get a weekly P&L and balance sheet reports. Monthly, I want them to get an EBITDA and KPI reports. Now, do I know they'll kind of know what the EBITDA means, kind of. But KPI reports? No. But I still want them to get them, and I want them to get them before I hold the actual monthly review so that I can take the time with them to really explain what is going on in them. Now, how long should this meeting take? I think you target it for an hour, but you don't put it on a clock. If you put it on a clock, and again, this goes to how do you build the services. We're going to talk about that in a little bit. I don't believe in billing for this in any other way than on retainer. You do not want your clients worrying about how much time is involved. That's why they're afraid to talk to the lawyer. This is costing me an extra $300. We don't want that to be in place. We want them to know that you're on retainer with them and you're there to help them. And if the chat takes longer, if the chat takes shorter, who cares? This is all in the perception of value of the services. So the interesting thing is if you're talking to somebody and they're learning new things while you're talking to them, how long do you think they can really last at that? An hour? 40 minutes? 2 hours? That's about it. Most people's, I joke about this. I wait till I see their brains scribbling out the side of their ears, and then I know we've covered enough. Because then the next time I'll have to do a Q&A review of what we did before in order to start with what we're going to do next. So the monthly reviews basically are taking the weekly and the monthly reports. Quarterly, I want to do balance sheet forecasting with them. I think it's important for them to understand longer term financially over 2 or 3 year basis where things seem to be heading. So I believe those are very, very valuable in the services side. What else? Well, again, there's the monthly chat, educating, reviewing aging receivables and payables. Why do I do that? Well, that's cash management, right? At what point do the aging receivables start to go to a collection agency? What is the cash implications of doing that? If they're delinquent on their payables, why? How do we work out of that? What's a better way of managing that as a capital resource? Budgeting. Very few of them know how to do budgeting. This is the mean average, and we do a projection, and holy moly, there we go. Again, this is why in our software tools we built a very sophisticated way of doing budgeting. Scenario building. This to me is the most fun because most business owners are always thinking about the future. And scenarios revolve around what are we going to do next? Where are we going to do it? What are the factors involved in it? How does it take place in such a way that there is another element involved in understanding the cash flow? Scenarios are a really important part of the services and they're fun because it lets them go, oh, I don't have to just go, is there enough cash in the wallet? I have to think in terms of what are all the factors that impact that. So the scenarios do that. So next, how do we structure the services? Well, first of all, as you've heard me say, it's on retainer. Why? They want to know this is a fixed amount out of pocket every month. It's on retainer. This is going in the general administrative elements in the P&L statement. Then they're not worrying about whether they're talking to you or not. It's on retainer. Secondly, you have to structure the services around the financial reports. So we've talked about what the reports are. It's on retainer. It is the financial reports. It's the monthly chats. You need to meet with them annually for a business strategy session. You really want to talk to them about what do they have in mind for the future. Otherwise, how can we build the budgets? How can we build the scenarios? How can we go about doing this? Future planning and risk management. This is where you're building scenarios. This is where you're building cash management. This is where you're understanding what you need for growth capital, for risk capital, for cash reserves. And this is where you start building in tax strategies. Capital formation. Is there a need for capital? One of the requests that came, I was over in the United Kingdom for 3 weeks. As many of you know, I'm opening Prophecy offices over in the UK. But one of the things the government asked us to do is could we add a tool to our software that allows alternative funding sources for the small and mid-sized business marketplace. And the reason was, flat out, the banks in London, in the UK, will not loan businesses to the SME marketplace. The regulatory laws and the capital requirements have become so oppressive that basically, if you could borrow money from a bank, you never needed it in the first place. So the banks are putting their institutional money in other places to generate capital. All well and good, but not to the SME marketplace. So what they asked us to do is could we meet with alternative funding sources and determine what combination of KPIs and balance sheet forecasting would be necessary to qualify for money from these alternative sources. Now, I mean, let's face it. Will you pay 2 or 3 or 3.5 percentage points more for the money? Yes, you will. But if the money over a 12-month basis is going to generate on the initial investment a 100, 200, 300% rate of return, who cares if you pay 350 bips over prime in order to get the capital? So we're actually in the process of, over there, I'm going over in another 3 weeks, of talking to some of these alternative money sources and integrating that into our tools. So if a business needs, you press a button, it takes the combination of the KPIs and the balance sheet forecasting and see which of the 30 sources fit the criteria and does a whole submission and so on. But in other words, capital formation is a critical part of what you need to do in the services. And how you go about doing it and with whom, I think, becomes an important element for the business owner, because the traditional sources have gone away. They just have left. One of my favorite features in these services is I call it unlimited spot calls. I always say, and oh, by the way, you will have unlimited spot calls. Now what that means is at any time, I can't promise I'll answer, but I will get back to you within 24 hours. If you've got a question, if you have something that you want to talk about, the proposal says you get unlimited spot calls. Now, this is a perception of value thing. How many spot calls do you think I get from my clients in the course of a year? Maybe 2, 3, I mean total from all the clients. And the reason is I've done such a good, an effective job, I hope it's good, but an effective job in the monthly chats, in the paper reports, in the annual business strategy meeting, the future planning, and all these other elements, that the spot call is just a, it's that sense of peace. And again, there's no charge to them, but it's a huge perception of value. So this is what I always put into a proposal. And then the question is, how much actual time does it take me to do it? Well, let's say if you've got ways of generating financial reports in an automated fashion, that doesn't take any time. You just identify what the reports are, and it's automated and sent out through email. The monthly chats, okay, that's going to take an hour, hour and a half, maybe a little more each month. I like doing them on Skype or on GoToMeeting. I think the video is phenomenal. It saves us driving all around the place. And there's something about the visual connect that's very, very important. Now, the annual business strategy meetings, those obviously are live and in person. So how long does that take? It's probably either 2 or 3 half days. I generally don't like to do full day sessions with clients. Occasionally I might, but it would only be with the management team and the executive group. And so I have to account for that. Future planning and risk management, I like to talk about that on the monthly chats as to business strategies, because that's where we're building scenarios and capital needs. And so maybe in the course of a year, that might be 4 to 6 more hours in the course of the year. Capital formation is kind of a non-event, and spot calls don't take any time. So in the course of a month, how many hours potentially am I really putting in? 2, 3, maybe 3.5, maybe. But the point is the perception of value is so high that I have an easy time, depending on the size of the company, saying I'm providing these services to you for $2,000 a month. I'm providing them for $1,500 a month. A larger company, maybe $3,000 a month. But the point is I'm providing them a CFO at a price they couldn't possibly get anywhere else, and the perception of value is high. Now, the hourly rate seems very, very high, but this isn't about an hourly rate. This is about actual value and a perception of value on your business client's standpoint. Frankly, if you say, my clients can't afford it, well, maybe you're just billing them $750 a month. Okay, for 2 hours, for 2.5 hours, I'll do that all day. It's a retainer-based business. It's an annual contract, and I know that's ready, steady money that comes in. And accountancy tends to be extremely seasonal. You pick up 20 business clients to do this with, even at $1,000 a month, that's like $20,000 a month. That's $240,000 a year in top-line revenue with a margin cost of maybe $70,000, $60,000. This is just smart. The business owner is getting services that they couldn't otherwise afford at a fraction the cost, and you're providing a value-added service that's increasing the valuation of the company, and you're doing pretty well in the context of doing it. So again, how do we look at the fees? Well, I think you need to do this on a 1-year term. You set up the agreement so it's a 1-year term. It's a monthly retainer. You bill for the first month in advance, and it's credited to the last month. It's renewable. In other words, it's going to automatically renew at the end of the year. But we're going to have a 60-day notice of termination. Now, I always bill this out at the first of the month, and if they're going to terminate, if they decide they don't want to go ahead, they have to give some certified notification. It can be a written certification, it can be delivered, but it has to be some valid notice of certification, and it's 60 days. So what does this mean? If the billing for the month starts on the first of the month, which it should, because you are committing the time to them in that month, and to replace that time takes you some time. You bill on the first, that month is due. They give you a note on the second saying they're terminating services. That means they've already paid for this month's. 60 days notification means 2 months in ahead. Not 1 month in ahead. 60 days would just be the end of next month. No, 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 no. The terms are 60 days of termination. Now, I've never had anybody question me on this, but a couple of people said, well, why do you do it that way? And I said, well, because, you know, we view our relationships as lifetime relationships. And the only asset we really have to sell over here is our time. And frankly, it's going to take me 60 days in order to be able to replace, you know, the services that we're providing to you. It's really not a big deal. If you really are worried about the 60 days and not making it 89 days, just notify us at the end of the month before we bill the next month. Now, no one has ever questioned this. And obviously, the renewal side, it can be terminated on either side, but you have to make it in such a way that the agreement has clearly defined objectives. Now, if there's finding this interesting, there's more you'd like to know about and how to go about doing it, why don't you just visit it at www.myprophecy.com/academy. We talk a lot about this. Obviously, our software tools provide these types of services. But mostly, I hope this has been a nice break for you from tax season, at least for an hour and a half. If there's any questions, obviously, we'll follow up on this on iShade's Ask the Expert session. I'll be very, very happy to answer questions. But mostly I hope you can help your business clients really learn to prosper in a more profound way and help redefine what's happening in your accounting practice, because the industry is getting squeezed as the services are getting commoditized and the markets are still suffering. So at any rate, that's what I wanted to share today. I hope this has been fun for everyone, and I'm going to pass it back to iShade.
Thank you, Peter, for presenting today here at iShade. So we'll now be moving on to iShade.com for our live Ask the Expert Q&A session. So I'm going to go ahead and give a short demonstration on how to do that. Okay, so you're going to log on to iShade.com. So you'll log in up in the upper right-hand corner, and once you're logged in, you'll click on the Ask the Expert tab here. And then once you get on that page, down here you'll see Peter's Building Your Practice During Tax Season Part 2 session, and you'll just click on Join Now. And then down at the bottom of the page, you can ask all your questions right here. Thank you all for joining iShade today. You'll be receiving a follow-up email shortly with a link to a survey. Please take a minute just to let us know what you think of today's presentation. We value your feedback. Thanks again, and we'll see you on the Q&A.
Bye-bye, everyone.